Hi, everyone. Welcome back to Wade into Wealth. If you're joining us on YouTube, you might notice it looks a little different. We've got a special edition to the podcast today. If you're listening, you wouldn't notice, but you will when he begins to speak in a couple of minutes. Who do we have with us today, Ethan?
Our special guest today is the chairman of our firm, George Conboy, who's been at the firm for almost 35 years. We can give you the benefit of still being taller on our video recording and even better looking on our podcast. But George has been a key mentor for both Chuck and I, and someone who's been key in the development for us professionally. And for the topics that we have today, we felt you would be a great addition for our normally scheduled podcast.
I have to agree with that. I think I would be a great addition.
Yeah.
I think my mentorship, if I can segue off on that for a minute, was especially important for you guys because you two both could benefit from being taller on video. So
Yes.
all three of us like that aspect of it, and I think I helped you with that.
Yeah, thank you.
What a guy. What a guy. So we want to talk about a couple of things today. We're going to get to something very local and native to Rochester, New York, and what happened with some folks in the city school district, perhaps misleading investors, and just another black mark on the Rochester City School District and things that have happened. But we're going to get to that later because there's a lot of folks maybe not native to Rochester. So if you don't want to hear that, that'll be towards the end. But first, we have a bit of an interesting scenario here, just the markets in general. And you can tell when you hear from certain clients or the conversation at the dinner table when I'm at my in-laws or with my parents is, ooh, stock market looks pretty rough. That's where we are right now.
It's funny because everywhere we go, people feel the need to tell us that.
Yes.
Really?
As though we don't know and we don't live it.
Yes.
I think
when you meet the eye doctor, you say, "Doc, my eye has been the same kind of thing."
Yes.
Yeah. So I'm curious to your perspective on what's happening and why.
So I have the same kind of thing, and because sometimes I'm a high-profile guy in Rochester, I'll be in the supermarket and someone I've never met will say, "Market's pretty rough now, isn't it?" Yeah, yes, it is. I listen to your podcast every week, and so as a regular listener, I know you've suggested to people about the idea of taking emotion out of investing, but it's difficult to take emotion out, and it's more difficult to take emotion out in a time like this. Mm-hmm. So what we spend a lot of time talking to people about is decisions tend not to be binary. That is, do I sell everything? Do I buy everything? It's not, do I do all of this or do I do all of that? It's often, how much of that should I do so I can still do some of this? There isn't a right proportion or an answer for everyone, I should say. But for each person, you may, if you decide you need to back off volatility, you don't have to back off 100%. You back off enough so you can sleep. And what it takes for you may be different for someone else, but if you can back off enough so you feel less pressure and you can soldier on through, that will get you through it and on to better times, I find.
I think so much of this is native to whatever anyone's individual circumstances are and how different that can be from somebody who's in their 30s or 40s, their 50s or 60s, their 70s or 80s, or different stages of life. And one of the conversations I've had a lot is that right now we're in the period where there's fear and there's uncertainty. Our job is to help you avoid the third part of that equation that I think is the worst part, which is regret. Fear and uncertainty we're in right now. Regret is what happens in the future when we look back and possibly say, I really wish we hadn't done that. And that's where I think having an understanding of your own circumstances and your own needs with respect to your assets and investments can go a long way into determining what's the best course of action right now.
Well, as you evaluate your own situation, one of the things you can do is things that will always be with you, things that can't be changed, maybe eliminate from your no, see, I don't get the professional microphone, so there's no cough button on mine. These guys...
We have them. We just don't know how to use them.
Oh, you know how to use it. Get out of there. But one thing that you can take out from your personal decision tree, you said there'd be fear and uncertainty and regret, right? The one thing you probably ought to take out of that, even though it exists, but don't consider it, is the idea of uncertainty. There has been uncertainty and will be uncertainty in every market forever. And I think back 30, even nearly 40 years now at the start of my career, and I don't think a month has gone by where somebody said to me, well, market, it's pretty uncertain right now. Boy, I don't know what's going to happen.
Yeah.
I said, well, join the club. I don't know what's going to happen either. So uncertainty's not going to be something you can ever change. The fear, you're not always going to have that. The regret, you're not always going to have that. How you deal with those two things is important. Trying to think about uncertainty wastes what little brain time some of us still have left. So I'd skip it if you can.
And a lot of it comes from where we're getting our advice. I had a client reach out the other day who mentioned that there was someone on the media that said the Dow was going to fall 80% and get to 10,000 by October. My response was, well, for every one person who says that, there's also a person who says that the market hit its bottom yesterday. And ultimately, that's what makes a market. Trying to make short-term predictions or trying to find a bottom in the market is a fool's errand. And what we know is that no one knows when the bottom of the market will be, when it will take place. But in order to recoup and make back the losses that you currently have on paper, it's imperative that after the market does hit its bottom, that you participate in those up days that follow shortly thereafter, because those tend to historically be some of the largest up days that the market has ever seen, and will mean the difference between making your money back or, Chuck, as you had mentioned, that regret.
I've heard you mention those things before. If you miss just a few days, it really guts your return. Something else to think about, a tool for your listeners or viewers, is when you hear a prediction about the market, it's going to be 10,000 by October or it's going to be 40,000 by October. Whenever you hear a prediction like that, it's hard to tell people, listen, you ought to just ignore those because you hear it. Maybe it's plausible. Maybe this guy knows more than I do. It's impossible to predict. It's impossible for anyone to predict, which is why three guys in a room on Monroe Avenue in Rochester, New York, don't feel sheepish that we compete with Goldman Sachs and Morgan Stanley and Merrill Lynch and anybody else, because they can't predict it any more than we can. But why am I confident of that? Why do I know that to be true? Well, think about this. When you invest, you're investing every week or every couple of weeks through your employer plan, or you call up Ethan or you email Chuck and you invest that way. Do you do it every day? Of course not. You do it every so often. Some things you do regularly, some things you do occasionally when you have a need to. You have money to invest, you need money to buy a car. But if you make an investment decision, whether it's a buy or a sell or whatever, if you make that decision today, you likely won't be doing the same thing tomorrow, and you didn't do it last week. Another group of people will be making that decision for themselves on their own terms tomorrow, and next week, next month, next year. Because markets are composed of millions, perhaps hundreds of millions, of individual decisions every single day, no one can predict whether tomorrow you will make one of those decisions. And because no one can predict what you're going to do, we also can't predict what everyone else is going to do, and therefore the markets can't be predicted by anyone, no matter how big or how small, no matter what computers or Ouija boards they're using. All right, end of rant.
If you offered me a roll of toilet paper or stock market predictions, I would take the toilet paper every day. Significantly more valuable.
Scatological comparisons, I don't go into all that.
Okay. Well, it's a reasonable point, and anyone who is trying to make a short-term market prediction is either lying or delusional. It's one of the two.
That.
Okay. So that's it. I mean, in some cases we sound like a broken record with this, but the reality is that's what's been shown to work over a very long period of time. It's not exciting because nobody ever talks about the plane that lands on the 6 o'clock news, but that's okay.
You ever have a plane land on the 6 o'clock news?
I have yet to see one.
Okay.
Except for when the president visits.
Okay.
Then they show a plane landing. But in general, hundreds of thousands of planes land each day, and we don't hear a thing about it. But when something goes wrong, and the very, very rare occasions when it does, it's the top story everywhere.
I believe that since this is a well listened and observed podcast, we should credit your reference of the plane landing safely. If I am correct, and I think I am, I believe that quote was, "The plane that lands safely isn't news," and I believe it has been credited to Gerald Nachman, the one-time executive editor of the New York Post.
Okay.
There it is.
Well, look, there's a piece of trivia. If you walk away with nothing else, you've got that little anecdote today.
We're delivering value.
Always.
Sure are. So we're going to transition now into something that hits a little closer to home. This is a podcast based out of Rochester, New York, where we all live and operate. And the Securities and Exchange Commission recently charged the city and some former executives and municipal advisor with misleading investors. When I first saw this headline, I couldn't help but just roll my eyes. But there's a lot of jargon here, and something you're very good at often, George, is explaining what's happening here. What are we talking about?
Okay, so what this is, the city and the school district wanted to borrow money from investors. To do that, they would sell municipal bonds. Probably a lot of your listeners have heard of municipal bonds. They're called tax-free bonds. That's where a state, city, or local government or government agency borrows money from the public, and they pay interest. The nice thing is the interest is tax-free, and so they can borrow at reasonably low rates. The city and the school district wanted to borrow money. It was a little bit over $100 million, $115, $19 million.
19.
Yeah, okay. And they want to borrow a considerable amount of money, $100 million and change. And when you think about this, if someone comes to you and wants to borrow money, if you think that they're not likely to pay it back or they might have trouble paying it back, you're either not going to want to lend it or you're going to want a higher rate of interest. So the city, the SEC is alleging that the city did not disclose some future troubles that the city knew about and expected, and that the school district also did not disclose that. In other words, the city and the school district were in difficult financial circumstances, and they didn't disclose it to investors. And had they disclosed it, they would perhaps have had to pay a higher rate of interest, or they might not have been able to borrow the money at all. That's the crux of the complaint from the SEC.
So I have to think that when the SEC comes in and makes a complaint and there are charges made, this is not something that was just drummed up over the last week or so, and they said, all right, well, let's make this argument and state these accusations. I have to think there's probably some teeth to these.
Yeah, by the time the SEC gets around to filing suit, I think the analogy I used this morning was all chambers of that revolver have been loaded and the hammer has been cocked. You hear that big click behind your head, and you turn around, you're looking down the barrel, and that's what the city and the school district are doing now. Don't forget, the city, two former city employees have already pleaded guilty to various violations of their of a variety of laws, campaign finance laws, and what have you. Mm-hmm. So there's some expectation at this point that these people may not be the world's most credible people, and I think it's very unlikely the SEC would pursue an action like this unless they felt they had adequate evidence of a problem to be able to charge them with a violation. Doesn't mean they're guilty, doesn't mean the SEC will win, but they're not going to step up to the plate unless they have a bat in hand and think they can knock it out of the park. How's that baseball analogy?
Very good.
Very good.
Yeah.
So I have another question, and because this is something that typically when there's an allegation made, there is a crime that has happened. We can look and say, all right, well, this was committed. This store was robbed, or this offense was committed. Someone was hurt. We can see that. Who has been hurt in this case? Because I'm not aware that the bonds were defaulted on, which is the biggest risk with any bond, is that the government or organization that issues them cannot make their interest payments, which is called a default, and typically a sign. That's when people really get hurt.
As of now, Chuck, you are absolutely correct. That will likely be a defense from the defendants. Look, no investors were harmed.
Okay.
We borrowed the money. We paid them interest. Everybody's happy. And the SEC will come back and say, well, it doesn't matter because the technical violation is this. If you go to borrow money for a mortgage, The bank says, listen, we need to see your pay stub, we need to see your tax return, what have you. We want to know how much you can afford. And the bank will lend you money if they think your income is adequate and the likelihood is that you'll pay your mortgage. Now, if you give the bank a pay stub and a tax return, but you know that you lost your job yesterday, there may not be a problem because the bank is supposed to verify that you're employed and whatnot. So some of that onus is on the bank to check you out.
Right.
But in the case of municipal finance, in the case of borrowing money from the public, there's a fiduciary responsibility, meaning an absolute responsibility on the part of the borrowers, the city and the school district, to disclose anything material that they know. So even if we're not in trouble yet, even if we haven't had a financial problem yet, if we think, holy cow, we've got a big budget shortfall, we've lost our job, we can't pay our car payment, they've got to disclose that to investors. And then the SEC will say, yeah, but investors may have been harmed because they bought a bond that they thought was backed by more quality than actually existed, and the investor ended up with a lower quality security. We spend a lot of time, as you know, as both of you know, talking about the quality of bonds and the safety of bonds, and a lot of investors never actually see that because things go right along fine, but we don't want something where we're going to take a chance. And the SEC's job is to protect investors, and here they're trying to protect investors.
Well, and while no one has been harmed yet, the investor taking that risk where they perhaps thought it was a more stable bond than what we're seeing it actually was, would have been paid a lower rate of interest for that period of time if these facts had been provided up front. So one thing when you're reading these articles and you're seeing this, there's a reference to a credit rating agency. So what role does a credit rating, because we talk about investors, but there are credit ratings agencies. And so what is a credit ratings agency, and what role does it play when someone like Rochester or the RCSD is looking to issue bonds to take in capital?
Sure. So Rochester, any municipality, rarely borrows all its money in its own backyard. If they're borrowing $100 million, $119 million, that's going to come from investors all over the country. So you live in Seattle, you live in Arizona, you live in Cranston, Rhode Island. You don't know anything about Rochester, New York, or their school district. So you rely on a third party, in this case, the credit ratings agency, to say, hey, these guys are good. They're sound. You have a credit report. People talk about what's your credit score. So the bank goes to lend you money for your mortgage. They look at your credit score because they don't know you personally, and they want to check and see if they think you're going to be good for it. So investors rely on the credit rating agency to say, this bond is AAA rated, meaning it's the best you can buy, or it's something less than that. And there are many, many levels depending on how sound the borrowers are. But in this case, had the school district and the city disclosed their problems, the ratings agency might have given them a lower credit score. If there's a lower credit score, the borrowers might still borrow the money, but they'd say, you're a little dicey. We'd like to get paid more. So the city and the school district might have saved the city and the school district some money in the short term by getting them a lower rate. But in the long run, between the legal fees and the possibility of making refunds to investors, you should play it straight from the jump. You'll save money that way. In this case, the city and the school didn't, and it will end up costing the taxpayers more.
My next question was, so who's on the hook for this?
Okay, yes.
And I think that's what's so frustrating about this, is that most of the folks listening to this podcast, did not make this mistake, did not do anything about this. We didn't choose to withhold this information. But because it is against the city or a school district, it's not as if an organization or one person can say, hey, you got to pay this out of your money. No, taxpayers have to make up for it, which another roll of the eye.
Well, here's what happens. The taxpayers get what they pay for, in a manner of speaking. I've done some broadcast media stories on this particular topic. And in broadcast media, I don't get all the time I get on Wade into Wealth. And I also have to be more circumspect. But I can tell you, in my personal experience with the city school district, my kids went to city schools. And in my extensive media contact over many years, I've had a lot of reporters bring me leaked documents. So I've seen a lot of stuff. And I would say in my estimation that there are two types of finance employees at the city school district, and those would be incompetent or criminal. Two types.
Neither of which is ideal.
Both of which will end up costing taxpayers more money in the long run. You know, it's a one-party state, and it doesn't matter which party it is. Anytime you hand the keys to one gang, you have a monopoly.
Yep.
In Rochester, we have great supermarkets. We've got Wegmans, but we've also got Trader Joe's. We've got Aldi. We've got Whole Foods coming in. They compete fiercely.
Yeah.
So you've got good prices. You've got clean stores. You've got a lot of selection. But when you have one grocery store in town, one grocery store, the aisles are probably dirty. You're going to pay more for that gallon of milk, and the selection's not very good. And in the city and the city school district, it's a one-party state. And when you hand the keys to one group and there's no competition to keep them honest, well, sometimes they're not honest.
And this is what we get. Any final thoughts?
Well, you give me an open microphone.
An open
I
microphone.
think I've run the course. I'm practically exhausted by this.
That's perfect.
Give me another topic. I can go on for a half an hour. I won't bore your listeners that way.
Yeah, well, let me ask you this. I think it's always good to leave someone listening with an action item from this or something you can take with this and use somewhere else maybe. Is there something here or something you could say, look, here's what we can learn from this, and so how we can maybe, or you could avoid this in the future?
Sure. If you've got more than 10 years to retirement and looking at the demographics of your podcast, I think many people who listen to or watch your podcast have more than 10 years to retirement.
I would agree.
So if you have more than 10 years to retirement, don't sweat these kind of markets. When you think about how you will invest to beat inflation, which is becoming a thing, how you will invest to really build your wealth over decades, the place to build your wealth is with equities, with the stock market. And the reason is not because I think it's good or I can predict it, because I can't predict it. The reason is because enterprise creates value. Think about what it means. There are two kinds of companies. Companies that make things, manufacturing companies, or service companies that hire people to provide services. Service company hires you, pays you $1. Bills out your services at $2, creates value. Manufacturing companies, they buy raw materials for $1, they heat them, pound them, put them in a box, sell them for $2 to create value. Only through value creation can you expect over time to have wealth creation other than what you yourself work and earn. So if you look at the long term, I know you guys talk about the long term a lot. Mm-hmm. You look at the long term, you look at rates of return, just imagine that buying now at relatively low prices compared to 6 months ago or a year ago, what that can do for you over the long period of time. So keep a long-term perspective. I'm reminding people, perhaps with different words, of what you guys have said many times. But that makes three of us.
And it's funny where the stock market is one of the few instances where when everything goes on sale, 25%, everyone runs for the doors.
Everyone runs, right?
But if you put a sign out in front of Wegmans that said whole store, 25% off, the parking lot would be packed.
Well, drop gas prices by $1 a gallon and see what happens.
Right. We just have to change the way we view our tools.
Drop gas prices by 20% and see what happens. You've got lines down the street. But you drop the stock market by 20% and you get fear and uncertainty and hopefully not regret.
Hopefully not regret. Emotion's going to bring regret more than anything else.
Sure
so
does.
To the extent you can eliminate or at least reduce emotion from what you're doing, you'll be better off.
Okay. Well, appreciate you making the time. You may have earned yourself a return invitation at some point.
Holy smokes. I like this. I do pay the rent on this building, don't I?
Yeah, I think you do. That helps. That helps. All right. For George Conboy and Ethan Wade, I'm Chuck, and this is Wade into Wealth.